The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, Tom Gentile. Welcome to our week 2 of our Trading Essentials webinar from Optionetics and Tom's Trading Room. Glad to have you guys here. It is straight up 8 o'clock and we're ready to get going. So thank you all for being on time. If you could, Jay, are you there? Could you just pipe in here for a moment and say hello and let me know I'm coming in loud and clear?
Hello, everybody. And Tom, yeah, you're coming in Lima Charlie, buddy. Everything sounds and looks good.
Awesome. Also, you should be able to see the screen, and we will get to rocking here right now. So, again, thanks for being here and being on time, guys. We have got a lot to cover, and we might go over a little bit tonight. I just want to warn you about right now. But there's just so much going on, and if you haven't seen the last couple of days, then you need to take a look at your screens because it has been a melt. We went from a melt up to a meltdown, back to a melt up again. But things are holding pretty good. I want to show you what we did last week. I want to talk about this week. We're going to go into Darknet, money counter, spreads, all kinds of stuff. I'm going to try to slow it down a little bit because I was told I was going too fast last week. That's what the recordings are for. But I still want to slow down and make sure that the majority of you really get it. It sinks in for you tonight. So again, thanks a lot. Let's go ahead and get started. I'm already recording this. So this session is being recorded. And we will get the recording out to all of you just as soon as this has ended, all right? As soon as it's ended and we can upload it to our servers. So that's number one I want to let you know about. Number two, if you have questions, you can put them in the Q&A box, that little box that you're hitting me at right now, and we will try to get to as many questions as we can. I will take time out throughout the webinar at least 3 times to answer questions for you. And of course, number 3 is, let me put it up on the screen here, is the disclaimer. All right, so this disclaimer we have on every one of our webinars that we do here at Optionetics and Tom's Trading Room. And you can read this in its entirety. In fact, all you have to do to read it in its entirety is 2 things. You could either do it on the recording or you could go to tomgentile.com, and we have the entire legal disclaimers right there on the website. This one I picked out, and I just want to mention a couple of things to you here. Number one, as we all know, stock and options trading has large potential rewards, but also large potential risk. The other thing I want to mention to you that's in here is that myself, Jay, and everyone that's associated with Optionetics or Tom's Trading Room, we are here as your educators. All right, we're here to teach you how it is that we trade. Okay, we're not personal investment advisors. We do not give specific trading advice or individualized investment advice. We're not brokers. You need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in U.S. dollars unless noted otherwise. All right, so many of you I found out last week were new to our Trading Essentials webinars, that you didn't catch us when we started this up again with Optionetics. Back around, I believe it was June of last year. And so I want to welcome you back. If you've gone to optionetics.com, you can see the changes that we have a temporary page up, and then later this year, we're going to be really kind of making this and shaping this into a website that is much simpler to use and really kind of gets down into areas that we have our articles on, ability to get to our software. But as you can see right now, there's a couple of things we have up there. Feel free to jump in and look around. Again, optionetics.com. One of the things that I didn't spend a lot of time on last week, and I'll do it right now, is part of the Optionetics website we have is for those of you that ever used Platinum before. All right, Platinum is gone. All right. The good news is that we have Platinum on steroids, and that's called tomsoptiontools.com. And if you go to tomsoptiontools.com, you'll see right here, I'm at tomsoptiontools.com. We have a 7-day free trial to any of our tools. And let me show you what I'm talking about. So if you click on the 7-day free trial, you can see the levels that we have. We have option trader level, which really just gives you an idea of what this comes with. And if you click on the what you get column, it shows you what you get with level 1. It shows you what you get with level 2, which we're going to be talking about Darknet today. That comes with the level 2 contrarian trader strategies level. And then level 3 is everything in 1-2 plus our money calendar. And I'm going to be talking about Money Calendar today, too, which is a computerized product that we actually filed a utility patent on. It is that good. Level 4 is our professional trader. This is something we do that includes live trading access. And right now, the membership is full. However, if you are interested, if you're really interested in level 4, then email Jay at support@tomgentile.com. We have a couple of spots that are open. We just haven't really advertised them yet, and he can give you the details on that. But we'll give you a very special price on that. Again, email Jay at support@tomgentile.com. Jay, if you could just type that in the chat box and let those folks know how to get a hold of you, and just make sure you want to talk to Jay about the professional trader package that we have. All right, back to where I want to get to, which is tomsoptiontools.com. I'm going to log in right now, and I'm going to set myself up for what we're going to cover today. All right. So what we are going to cover today is we're going to do a review of last week. We're going to talk about spreads. We're going to trade with the Darknet and the Money Calendar applications. That's our plan. All right. Next week, as you can see, we're going to be doing a review of tonight. And we're also going to talk about trading credit spreads. And my guest on week 3, who is part of the Optionetics Tom's Trading Room group, is Devin Pearsall. And so he comes and shares this with us just once a year. All right, so this is the time if you want to learn about credit spreads. Next week, you want to definitely join us. We'll talk about that at the end of the program today. So last week, we did a session called All About Calls and All About Puts. And I do not plan on getting into this in any great detail today. Because you have a recording you can go back and look at. What I wanted to do is I wanted to review this, and I want to talk about spreads, and I want to go back and look at the Flying Five that we looked at last week, okay, before we get into Darknet and Money Calendar. So calls simply give us the right to buy. We know that. If you're buying calls, it gives you the right to buy. That's a bullish strategy. If you buy puts, that gives you the right to sell. That's typically a bearish strategy that we use here at Optionetics and Tom's Trading Room. All right, we talked about these last week. We talked about the costs. We talked about the risks. We talked about the rewards. We talked about the opportunities. All right, we shared with you some homework assignments, and I went through these last week. And we looked at these Flying Five stocks. Now, the Flying Five stocks, for those of you that were not here last week and didn't have time to look at the recording, these are the cheapest 5 stocks that are part of the Dogs of the Dow, a once-a-year strategy. And what we did last week was we analyzed each of these. All right, Verizon, Pfizer, Coca-Cola, Cisco, and GE. And what we determined is whether or not we could put call option trades on them throughout the year using a strategy called a leap, an option strategy called a leap. And some of them look good with calls. And some of them look like maybe they're too expensive, or there was a way to reduce the cost, reduce the risk, and actually even have a better reward on your risk than a call option. And that's what's called a call spread. And so before I go into these, all right, I want to talk a little bit about what call spreads are. And we're going to talk about learning about spreads. Then we're going to take a look at Verizon and Pfizer and Coke and Cisco and GE and determine which one of these, which one or more of these 5 could have call spread opportunities instead of call options. So we'll take a look at those. All right, so let's talk about trading spreads. We get into trading spreads. Before I get into those, I'll do a quick little Q&A session with all of you in the room. So trading spreads, what are spread options and why do we trade them? Spreads are a way of trading more than one option simultaneously. That means what you're doing is you're buying a strike and you're selling a strike, and you're trading the difference between the two. Now, my son was telling me tonight, I didn't even know this, when you got a kid that sleeps all day and he's up all night, you don't see him too much, all right? But I saw him. He woke up early. He got up at 6 today, 6 p.m. And so anyway, he says, I did a spread on Apple. And I said, you did? And I'll walk you through that in just a moment. But he did a spread on Apple, and he's using an option that expires at the end of this month. So he said, I've already maxed out. And he's ready to sell. And I said, well, hold that thought. And because I had an idea for him, and I'm going to share that idea with all of you in just a moment. But he took a spread trade in Apple. He did 2 contracts. All right, man, this kid's in college. So I don't know how he manages to go to class and stay up all night and sleep on his days off, but he does it. All right. And he maxed out his trade. That means he believes he made a maximum profit. So I taught him a little strategy tonight that he didn't think about that will assure him of a maximum profit so long as Apple stays at or above a certain price. We'll talk about that too. But before we get into exit strategies, let's talk about the entries. So bull call spreads are a way of trading really high dollar stocks like Apple, Netflix, Priceline.com, the real expensive stuff that can allow you to put a trade on for, in a lot of cases, $500 or less per contract spread. And you're able to trade something like a $1,900 stock or a $1,950 stock like Priceline.com, which closed today at $1949.90. And instead of buying the stock or 100 shares, instead of buying these call options, which have got to be expensive, all right, we can look at bull call spreads. Now, last week, Priceline.com was in the 18s. All right, it was trading about $100 less. And I'm sure many of you might be saying to me, why didn't you tell me about Priceline.com last week? Well, because last week we were talking about calls. And Priceline.com calls are expensive. Plus, if you were following us, because we do live webinars with our group 4 days a week, then you would have known back just after New Year's Day that Priceline.com was on our radar, back when it was at 1,800. And so that was the time to really start to get long, although I don't think it's over yet. I think Priceline.com is going to be a $2,000 stock in the next 30 days. And so we can take a look at that one as an example, as a trading example, and how we could trade that right now. So bull call spreads, again, they allow us to lower the overall cost of the trade, lower the overall risk of the trade, and lower the fluctuation. Because when you look at a Priceline.com that can have a trading range, today's trading range, by the way, was almost 40 points. It went from 1920 to 1960 and then backed off a bit. And so those are rough estimates because I'm just looking at a big candle on another screen. But let's talk about an example of what this would look like using a non-stock, and then we'll equate it into a real stock. So Priceline.com, is a real stock, but we'll start with XYZ. So an example is, let's say you're looking at a stock, and we'll call it XYZ, and you're looking at the 100-120 call spread. You're saying, wow, this is a big spread. But the 100-120 call spread going out in time, the 100 calls are trading for 10, the 120 calls are trading for 5. So your debit on the trade is actually what you paid for the 100 calls. That's $10 per contract, and what you're selling the 120 calls for. So you're paying out 10, but you're bringing in 5. So your net debit on the trade is 5 points, or in this case, that $5 times 100. All right, for the spread, $500. We call that buying the XYZ 100-120 call spread. All right, so you're long the XYZ 100-125 call spread. This is what it would look like on one of those old classic risk graphs. That means that if you paid $5, you're paying $500 per contract for this spread. That means if it goes below 100, the worst case scenario you could lose is the $500 for the spread. If it goes up in value, you've got to break even. All right, your break even at expiration is our break even is 105. You determine the break even by taking the lower strike and adding on the cost of the trade. So if the lower strike is 100 and you paid $5 for that spread, then you take 100 plus 5, and 105 is your break even at expiration. Keep in mind, your break even today is where you are right now minus slippage. All right. So if you enter an order on this, some people that have never traded spreads before think that they're already out that $500, for instance. No, because what you're paying for is what it's worth. Maybe there's a bid and an ask in there. There's some slippage in there. But when you take that trade, that's what the trade is worth at that time. Where it goes from there, obviously, is we'd like it to go higher. but we know our maximum risk is at or below 100. Our maximum reward is at or above 120. You might wonder how come there's a max on the reward. The max on the reward is simple. If you have the right to buy at 100 and it goes up, that's good. But if you have the right, if you're obligated to sell at 120, then you're on the short side above 120. So you're long at 100 and you're short at 120, which is not a bad place to be. Being long at 100 and being short at 120 is a good thing, because could you imagine you have the right to buy something at 100 and you're being forced to sell it at 120? I'd take that deal all day long if I could. All right, so that's the spread. So let's look at some different situations of what can happen in the max reward, max risk area. So if the stock goes from 100 to 120, all right, Trader A is one that buys 100 shares and they paid $100 for that. So 100 shares times 20 points up is $2,000. That's a 20% return. Trader B buys a call option for $10. Well, if the call option went from 10 to 20, your call's worth 20, so you made 10 points or $1,000 on your $1,000 risk. All right, your risk is $1,000 per call option, but now that $10 has grown to 20, so you make $1,000. That's a 100% return. However, if you bought the 100-120 call spread and you paid $5 for it, your cost is $500. Your maximum reward is $1,500 at 120. So at 120, you could be in a situation where you have $2,000 or a 20% return, you have $1,000 or a 100% return, you have $1,500 or a 300% return. Okay? So when you look at this, the stock trader in this case is always going to have more money on a 100 shares versus one contract versus one spread. All right? The contract trader, Trader B, has unlimited upside but limited risk. So there's an argument there that Trader B might have the best position. But at this point in the chart, if we're at 120 and we're near expiration, Trader C currently has the best position because he or she only spent $500 and is currently up 300%. Right? Now, we could look at this another way. What if the stock goes from 100 to 50? I mean, if Bitcoin were a stock, in the last couple of days, it's dropped 50%. You know, we've seen it drop off. It's funny because I saw Bitcoin go down to 9,200 at about 10 o'clock this morning, and now we're back up at 11,500. So I mean, this thing is just, that's what the cryptocurrency guys call a nice healthy pullback. when you see that kind of move happen, they don't understand that we look at pullbacks and it may take weeks or months. They look at a 50% pullback, a couple days, and that's it. So anyway, let's say that we see a 50% pullback on this stock that goes from 100 to 50. Well, the person that bought 100 shares for $100 a share just saw a $5,000 loss. These two traders look much better. Trader B and Trader C can only lose the amount up to what they paid for their option trade or option spread. For Trader B, that'd be $1,000. Look at Trader C though, $500. Again, if you want to paint this in a silver lining picture, Trader C had the least to lose. So you want to know? Well, you want to know why I trade spreads? Lower cost, lower risk, and just a better scenario on both sides. But I like to do this on the higher dollar stocks or on stocks where, on options where I can put it together and I can get a healthy reduction in my trade cost by simply putting this position on. Put spreads. So put spreads are just like call spreads. Only difference is that we look at put spreads when we're bearish. We buy put spreads in bearish opportunities. So we buy a higher strike put and sell a lower strike put. And we obviously use that on the same expiration date on the same stock or ETF. Right? Lower cost, higher reward, and higher profit potential. One of the trades that we mentioned, this was actually late last year, and this was right before the holiday break, and this was a put spread. We were looking at IYR. Okay, IYR, and that's the iShares. That's one of the iShares index ETFs, and at the time, IYR was trading around the $84 area, and we were looking at the 84.80 put spread. All right, did that for around $2, a little less than $2. And currently, IYR is trading in the 70s. In fact, it's at $77.73. And that trade expires this Friday. So I want to talk about exit strategies in just a little bit because got one that's kind of going off the board here in a few days. So when it comes to choosing the perfect spread trade, it really depends on, depends on opportunity. And if you're a good stock trader, then, and you can, and you've got something that can help you predict or average in on price and time, spread trades are really a fantastic opportunity. And so, last week we looked at the Flying 5 stocks, and I talked about looking at creating trading strategies out of them. And so what I want to share with you is I took the trading strategies that we did last week in class. All right. I haven't changed any of them. I'm just going to bring them back up again. And so as I slide, actually before I do, let me first check and see if there are any questions when it comes to spread trading. All right. Jay, do you see anything out there that I need to sound off on?
I answered a couple. One was asking about the most you can lose, and I think he answered that. It's the amount of the spread times the number of contracts offset by the credit. And then, do you have any comments on how IV comes into play?
Yeah, I do. Well, what we can do? We can go in and we can look at, let's look at some of these stocks and we'll look at the IV charts on them because IV does have a good bit to do with whether I'll take a spread or not. Absolutely.
Sounds great.
IV's and IV for those of you that are new to some of this lingo is implied volatility, which implied volatility is just based on the time value of your option. All right. Implied volatility has nothing to do with an option's real value. It's all the extrinsic or time value of the option. And part of that could be the trader's angst in so much of where a stock is likely to go. And they may pump up that premium, and that means your IV would rise. We'll get to that. Let's move over and let's take a look and see what I'm talking about. So we can look at these trades. What I did was, Jay, I put these into our option tools. We have a little area called portfolio performance. And so I looked at our portfolio performance. So I put these in last week. All right. And as you can see, we've got some Cisco trades, we've got GEs, we got Coca-Colas, we got Pfizer's, and we got Verizon's. And so let's just take a look at each of these. So I've got the Cisco January 18, 2019 call option. All right, so that's one. And what we can do is we can go in here with a trade plan and we can, go through and I don't want to spend too much time on this, but I just want to show you what you can do here is you can see this particular trade. We can look at the trade plan. We can alter it. We can also go in and look at its risk graph, which is where I want to go. But we've got everything in here from what you can put in for a profit target, your acceptable stop loss, whether you want to see a price high alert or a price low alert that you can get tagged with alerts. We've got technicals you can put in here. You can even write in your entry rationale, any money stops or other stops you have, and then fundamental stops. And this all becomes a journal for you. All right. So where I wanted to take you was the actual risk graph on this particular trade. All right. So here is the trade that we were looking at. This was last week, the 10th. And we looked at buying the Jan 1837 call. All right. $4.78. Now, where is this trade right now? This is Cisco. So the trade right now is at 570 by 590. So it's up $102 just in the last week. But as you can see, look at the market. The market's up pretty big since last week too. So we're benefiting from a surge in the market. But remember, these are leaps. This thing still has 366 days to go to expiration. But there's your risk graph right there. All right, this is your maximum risk down here on the bottom left. This is your unlimited reward on a call option on the way up. This shows you how well Cisco has performed just in the last recent months. And if it continues to do this well, we're going to be up here in no time. All right, so we can do that with each one of these. But what I wanted to show you was going into our portfolio charts. So I took call options. In fact, I took all the trades that we had, both Cisco trades, and there's a spread in here too. There's a GE spread. I put a spread on GE last week just to see what that would look like. And then we've got Coca-Cola, we've got Pfizer, we got Verizon in here too. Obviously, you can see on the the profit and loss part, and that's what I want you to look at, is that Cisco, both the call and the call spread are doing well. I mean, you can see here that there was the from the trade at the time, we had 102 as the highest, and then 0 is the lowest, and 102 ending. This one went from 83 to 27. Currently, it's 83. That's because Cisco's sitting on new highs. Look at General Electric. This was the 15-20 call spread that I looked at last week. Well, the best it did was it was up $57. Today, it dropped $17, and the reason I know that is currently it's sitting at minus a $17 loss. And the 18 call, the best it did was go up $9, and it had fallen down, and now it's down $85. But you can see Coca-Cola has profits, both on the call and the spread. All right. PFE, Pfizer has profits on the call and the spread, and Verizon has profits on the call and the spread. And so down here, I can look at a portfolio performance. So what I'm showing you here is that we've put in some call options and we put some spreads in on the Flying 5. And so adding all those together, there's a total of 10 trades that are in the portfolio. Right now, all 10 of them together are showing a combined, call it a P&L gain right now of $242. Right? There's $363 in gains right now and $121 in losses. Okay, 64-30, 60% winner, 30% loser, and I'm not quite sure why I'm getting a 60-30. That means there's something else that is there must be a break even in there somewhere. All right, so there you go. And then there's some other information that you can garnish from this, including R multiples, expectancies, for those of you that are math wizards in the room. But I didn't get into yet real time putting together a bull call spread. So let's put a bull call spread together in real time. But I'm not going to use the Ciscos and the Cokes and the more boring stocks. I want to look at something else that I think is going to really grab people tonight. So we're going to look at options, and we're going to look at option chains on Priceline.com, which I believe is clearly one of the biggest stocks to get into to the upside, PCLN. So PCLN, and I'm going to click on update, currently trading at just under $1,950 per share. So if I'm looking at 2000, and we're going to go and I'm going to show you what it is that's got me so excited about Priceline.com and has for the last couple weeks, and will continue to for probably the next month. All right, what is getting me so excited about Priceline.com? Is it the fact that it's the trend is on fire right now? Maybe. Is it the fact that this stock more than not goes up right into its earnings announcement, which by the way is the middle of next month or the end of next month? That's part of it too. But there is one more piece that to me is the most compelling reason why I like Priceline.com right now. I'll get into that in a minute, but let's go ahead and let's use this time to look for a 30-day, there it is, February 16th, 2018, a 30-day option, all right, with Priceline.com. And let's just look, let's just look 5% up. Can we just get a 5% jump in the price? And where does that take us? So you see what I did under PCLN? I put stock limit to 5% above and below. All right, let's scroll down. Let's see what we've got. So here's the stock price, $1949.90. This is 5% up, puts us into the 2000s. Okay, so if 2000 really is our target, if that's an example of our target as of today, let's sell 2000 and let's work our way down. And maybe we buy 1990. All right, so remember, we're looking at the target first. The target is the sell area. And then we start working our way closer to the stock price, and that's what we're looking to buy. So I'm looking at a 1990, 2000 strike. All right. The 1990s are going to cost $27.85. Looks like the 2000s are around $24.60. Let's see what that looks like when we put that spread together. So clicking on the risk graph, what have I done? I have bought the Priceline February 16th, or at least, no, I didn't buy it. Let me clear up here. I am looking at buying the Priceline February 16, 2018, 1990 call, and I'm looking to sell the Priceline February 16, 2018, 2000 call. Right? I'm going to pay $27.85 or more for that. I'm going to sell for $24.60 or less. But the combined price of this is right now costing around $325, right? Now, I look at that, and we'll talk about where I like this on the fill side in just a moment, all right? Because this is a mid-price. This is half the distance between the bid and the offer on both of these. So if I added $145 to this number, that would give me the market price, going in at the market, which I do not do. So I want to find a limit somewhere in between these two, and I've already got my eye on something, and I'll get to that in a moment. But you can see this. This is your bull call spread. You can see what it does. It has limited risk if Priceline were to fall apart. By the way, take a look at this, guys. Look at this. Huh? We're sitting on all-time high resistance right now. So it is very possible that we can get up into the 2000 area, even in the blue standard deviation, which, by the way, we were just at the blue standard deviation before it just a few days ago, and last week we were at the red standard deviation. So it's entirely possible that we could red standard deviation up in another week, which would put us up here in the 2000, almost 2100 area. All right. These different lines you see here, okay, these are theoretical option prices this is based on today, all right? And then, so the red line is 30 days to expiration, the blue is 20, the green is 10, and the black is 0 days to expiration. So what this does is this prices out the option, and it takes a lot of things into account. It takes into account the days to expiration, the stock price, the movement, that's volatility. It takes into account interest rates that are being paid out right now, all right? So it looks at these different variations, and we call them Greeks. What's the stock doing? That's delta, all right? How's the option performing on a day-by-day basis, and does it increase or decrease in value more or less? It's gamma. How much time do we have to expiration? That's theta. The implied volatility of the option itself, that's vega. And interest rates, which is rho. Now, that's probably about as intelligent. That's the most intelligent you're going to get out of me tonight when it comes to Greeks. All right, I am a price and time guy. I don't like to dazzle people with a lot of long words and not big math equations. Okay, because at the end of the day, the only math I'm interested in is dollars and cents. And so here, this tells me I can get into this trade for $325 and have a maximum reward of $675, which is about 200% reward to risk. Now, come down. I want to show you this next chart. This right here is implied volatility on the left-hand side. Look at what happened as we got to the earnings report, the last cycle of earnings, which, by the way, was somewhere around the end of October. Look at what happened. We had implied volatilities go from the 15 to 20 area, and actually the option that was the 30-day option, which, by the way, will be in the 30-day option when this comes back around again with this particular trade. Look at this thing. Went from 15 up to 50. I mean, that's a triple in your implied volatility. That means time value is going into the trade. And we want to be out of this, by the way, before we get to this tippy top and fall. All right? And so part of putting this trade on means that if you take a look here, the earnings are on the 27th of February. What is our expiration? The 16th. We are well ahead of this. You can't hold this option through earnings. It is impossible because the options expire before the earnings. But we want to ride the wave of let's get in ahead of the earnings. That's what a lot of institutional traders are doing. And I think that's a lot of what pushes this up. It's not the most compelling reason, though. All right. Buying the 1990s, selling the 2000 for the third week of February. There's the trade. What I want to do is I want to lock that in, and I'm going to save that. And now I can look at my broker's platform and decide, all right, what am I looking at here? I like this honestly at $4 or better, $400 risk. All right, because $400 puts it $75 above this level. This is $145. So $70 is a little bit more than half of the $145. And I think that's a good number to go in with. You got $4. The most you can end up making on this trade, if you're buying it at $4, the most it could widen out to is $10. And the reason I know that is because what's 2000 minus 1990? 10. Okay? So if you buy it at 4 and it actually goes up to 10, that's 150% reward. All right? Now, of course, I like to get out of half of my trades when they double in value, so I need to buy at least 2 of these. 2 and 2. To be able to get out of one spread contract if it doubles in value. So, I'm going to update this trade. I've saved it already. It's now in my portfolios of trades, and I can move that into any different combination. I'm going to get back to this one in a little bit. But you can see what we did here. We took a $2,785 call option, and by spreading it, it became a $325 call option. We shaved off a ton of risk. Now, we're not going to make anything above 2,000, but I mean, you know, you really got, I mean, in order to get to break even on the 1990 call, if you were to simply buy it on its own, you've got to go $27.85 above 1990. You got to put yourself somewhere around the 2017 area, which is 17 points above where we max out, right? A couple weeks ago, we were discussing the 1890, 1900 options for this same expiration. Those are already in the money. And by the way, those have now more than doubled in value. In fact, they've actually tripled in value since we first started talking about that spread. All right. Okay. Let's pony on back. Before I get into spotting opportunity, Jay, any questions?
Yeah, interesting question here about where was it here? Did you mention something about leaps on Priceline?
No, I mentioned leaps. I mentioned leaps on the Flying 5. And the reason you want to do leaps on something like the Flying 5 is because they're just so boring. They don't have the kind of volatility in them that a Priceline.com does. So if you want to sell spreads on a leap or on spreads on Flying 5, you got to go out long term.
And then the other question was on earnings reports. And with long calls, it's much more risky, but with spreads, your risk is kind of established ahead of time. So, you know, do you have a thought process on holding over earnings on a spread?
I agree, but you know, also keep in mind that one could argue the fact that your risk is limited on a long call too. But I do agree with you. You've got a lot more. You've got theta risk. You got higher theta risk. You got higher vega risk, which is volatility. And yes, if you go through an earnings report, I'll tell you this, guys. You know, we're going to do an earnings report webinar sometime this year. All right, when I can find some time in my schedule to do it. We do them once a year. And one of the things that I want to teach you is the way that I approach earnings and the way I do not. But I can tell you right now, I'm not a big fan of holding something through earnings. I'm a big fan of spotting an opportunity where a stock price actually goes up right up until the earnings date, and you get out of it and you sell that. It's like, you know what, Jay, to me, holding on to a call option through a big earnings report that could take you one way or another is like holding on to 2 tickets to the Super Bowl, and you're going to hold on to them until after the halftime show's over. What are they going to be worth then, especially if there's a blowout, you know? So that's the way I look at it. It's a very good analogy. Anyway, we want to talk about spotting the opportunity, creating low risk trades, and plan, executing, and managing the trades. And so I'm going to come back around. I'm going to talk about Priceline again, because Priceline actually has something else in common with it that we really like it as a trade candidate. And I'm going to get to that. So let's talk about Darknet signals. Now, who in the room, when I say Darknet signals, who in the room has never heard of a Darknet trade? Just say yes in the, or not me. Yes or not me will work. All right, so gives me an idea of, wow, got a lot of not me's in the room, Jay, and a lot of yeses. All right, great. Well, we're about to teach you something here. So I want to show you something pretty cool. Before we get into Darknet signals, let me show you what a Darknet signal would look like on a chart. So charts. If I go to stocks and charts, and I go to stock charts, I have a really interesting way that I can look at charts that is a little different than most people. So here's Priceline.com. Let me throw 100 days on this chart. All right, it's going to make the candles a little bit smaller, but I think everybody can still see this. Ugh. I don't know how this was going to turn out. I know this is not a Darknet candidate, but let's look at it anyway. So what we do is we look at what's called channel collisions. And this is where we take a look at short, intermediate, and long-term channel trends. And when they collide in different areas, that's when we see potential breakouts or breakdowns occur. So to me, it's a contrarian strategy that you don't have to worry about wave counts changing every now and then, because these buys and sells stick. So let me show you what I'm talking about. We can look at channels a couple different ways. I can actually go and look at just channels, all right, by looking at the stock, and I can instead of stock chart type, I can come down and look at channels. I can look at Darknet. Let's see if now Darknet's just going to show us any buys or sells that happened. Ooh, looky there. There's another reason why we were interested in Priceline last week, was that we had a buy signal that came up on it. And look what's happened to it since then, right? Has moved higher. By the way, I'm looking at the wrong day, I think, because we had a Priceline breakout that actually brought it up to new highs. For some reason, I'm not showing the, oh, wait a second, that's the gap. Okay, that's why PCLN. That's why Priceline, I got Priceline as a buy on, there it is. So there's your Priceline buy, it was a few weeks ago. Isn't that beautiful, Jay? That's compelling. You know what else is compelling? This isn't the only reason we like Priceline. I'm going to show you another reason why here soon. But look at this thing just continuing just to blow out from 1750 was the Darknet signal. One of the best signals we've had on Darknet in months. I mean, we got a lot of good signals on Darknet, but this is by far the one that's got the most point value heading for it. 200 points later, here we are today. But I want to show you some other things on here. So instead of stock chart type on Darknet, take a look at channels. Now, channels will give you a couple of, and as you can see here, we had a channel that was up and then it broke down, which is why we see the red. But then it's been green ever since. And we've been staying in an area of this equilibrium. So we have the support channel, the equilibrium channel, and the resistance channel. We're now getting up there to around that resistance channel, which, by the way, is around 20, it's really around 2040, which, by the way, was 5% higher when we just looked at it. All right. But let me show you another channel piece too. We can do a channel test down here by looking at up, down, and sideways channels. All right. And so this is how we were looking at this. We were getting all this channel collision down here, but you can't see it here like you could if we went back on that particular day, because then you'd see all these channels all colliding right here, giving us a really nice looking buy signal, which gave us our Darknet buy. Now we're seeing a little bit of channel collision that's happening here on the sell side. We don't have all three of them coming together, but we're now getting some early detection that this could move higher, and I do expect it to move higher. But we got to get through this resistance point here, and then this has to switch. But we did get a buy based on what we call channel collisions. So Darknet is similar to Elliott Wave, all right, in that it's a contrarian strategy. Where it differs is that the signals are steadfast. That means that they never change. That's the biggest problem I always had with Elliott Wave, is that if I look at 1, 2, 3, wave 3 buys, or wave 5 buys, etc., if we got a new low or a new high, the thing would move. And all of a sudden it'd say, no, Tom, this is the wave 3 buy, or this is the wave 4 buy or wave 5 buy. Darknet signals never change. We have 3 different signals that occur in a Darknet trading strategy. The other thing I want to let you know is that Darknet is a buying strategy only. It does not short sell, all right? Because in all of the work that we've done, we have determined that the buy side trades have the most potential for profit. The sell side trades are really a toss-up, which really was an eye-opener for me. So I want to let you know that again, it's a contrarian trading system. The signals, once you see them, they never move, and that it is a buying strategy only. So this is an example that we have on the screen with Greenbrier, and you can see the buy signals. Here's a sell. So a buy and a sell, profit. A buy and a sell, small profit. All right, and then a buy signal that came up middle of last year with this example. what we get is we get a breakdown of all of the Darknet trade signals. We can get that breakdown every single day. We can even go in and determine what we want to look at for signals, what type of slippage factor we want to see, anything that's less than a typical example, anything where the delta is going to be greater than a certain number. You could put the delta in between two numbers. This is all things that you have the ability to toggle back and forth with our Darknet system. The other thing I want to mention is that we rank these by percent to double. So the ones at the top need the least amount of movement in terms of percent movement in the stock in order to get a double in the option idea we're looking at. Okay? And then you can click on these and you can see what they are. So there's a lot of things we can do with this. And I want to show you right now how this works using tonight's data. So let's move over to Darknet. And here is Darknet right now. And so what I did was I'll bring up the Darknet stocks because I actually did toy around with this a little bit just before we came on. So here's our Darknet stocks. I'm going to run a search. All right. Now take a look at this search. These are all the trades that Darknet came up with today. So how do we bring these down? Again, there's a lot of different ways we can do this. Okay. We can go in here and we can just say, you know what? I want to look at anything that has a slippage of let's call it 0.3. That's going to get rid of a lot of this. What do we got there? 37 trades. Now we only have 8. This is much better. 8 trades. Let's take a look at these 8 trades that we see here. And so I see iShares, the MUB. This is the National AMT Free. Take a look at that. So if you click on the actual price tag of this trade, this will bring up an example of what this is going to look like. And this shows, again, this is just 100 shares of stock. All right, let's back this up a little bit again. So I have a couple of different ways of looking at these. All right, Pinnacle West, I can bring up the chart just by clicking on the actual symbol. All right, MUB, bring up the chart by clicking on the actual symbol. Now, I also have the ability to go back and back test this up to 5 years. So I can see how well has these performed in the past. But looking at the visual charts can give you an idea. All right, we have 3 different signals. We have what's called a buy or a B. We have an R, which is a rebuy, which is a second buy. And then we even have a third buy, which is called an A or an add-on. And so you can have up to 3 signals that are open before you see the sell, which closes up everything. So notice we have a buy, a rebuy, and a sell on this example. A buy at 111, a rebuy at 110.70, and the sell at around 111.20. Right? Maybe the National AMT Free isn't your cup of tea. So maybe we look at Pinnacle West. Pinnacle West shows a buy back in September, and that was around 84. The sell came in at 88. Here's a buy at 84, and here's a rebuy. Level 2 rebuy at 70, looks like 78. This came in today, right? IYR, which, by the way, I'm short. Look at this short. I mean, we were up in this area here, and then just boom goes the dynamite. And this thing dropped really hard. But now we see that we got a buy signal on this. Now look at this. The last time I saw buy signals, we saw a sell and then a buy and then a sell, and it went straight up off that buy. So guess what I'm going to be doing tomorrow? I am going to be getting out of this because I do not want to see this thing within a couple of days go from, for instance, right now it's trading down here around 77. All right. I'm looking at, we were looking at shorting at the 84.80. So 80 is really the place I do not want to see this at. Can it get to 80 in 2 days? I don't know. Maybe not. I mean, it would take a lot for it to get to 80 in 2 days. I don't see any place on the screen where it's gone up more than maybe a point in 1 day, 2 points in 2 days. It went down real hard back here before Christmas, where it went from 82 down to around 80.5. But that's still only a 1.5 move. So we might be safe on that one. Why do I mean safe on that? Well, because there are 3 things you could do with spreads just like you could do with options. You can sell them. After you've bought them, you could sell them. hopefully for a profit, but you could sell them regardless. You could let them expire worthless if it goes against you, but what if it goes in your favor so deep that, you know, and you're getting close to expiration? You could let your long exercise and your short get assigned, and basically what happens is the whole spread gets carried away, and you get the maximum profit on the trade. Okay, if we went back and looked at Priceline.com for a moment, let's say that we took this trade and Priceline went up to $2,050. It's way up here, and your broker sends you an email and says, "Hey, you have just been assigned the short 2,000 calls. Somebody just assigned you this option, so now you've got to be short the 2,000." Now, most people that are novices would pull their hair out and run around and scream and say, "Oh my God, what have I done?" But if you look closer, you own the 1990s. So if you're short Priceline.com, if your account, all of a sudden you got short Priceline.com, or your broker wants that money to cover that short, you can let your broker know that you would like to exercise your 1990 calls, because your 1990 calls are long. So you could be long at 1990 and then short at 2,000, which basically means your stock's carried away, and you get to keep the full 10 points. What's better is you got 2 bonuses. Bonus number 1, no commissions, because you didn't have to sell it. It got exercised. Bonus number 2, no slippage, because it got exercised and assigned. You didn't have to trade out of it for the slippage. I call that the double bonus opportunity if you can get to expiration, and if both of these are in the money. So that's what is happening with us with the IYR. So back to Darknet. So I'm looking at Darknet signals. I'm going along here. Another way that we can filter this. All right. Let me show you another way we can filter this. I'm going to put this back to 1.5. Let's do a search. So we had that 30 some odd trades that we were looking at. There's a lot of them here. All right. You could filter this by bringing your list down to maybe the S&P 500. Here's the S&P 500 optionable list, which we already have in our program. Now I'm looking at the top 20. All right. Maybe that isn't enough. Maybe I want to look at the S&P 100 optionable and just look at the Darknet stocks that are in the top 100 of S&P 500 stocks. And there they are. Southern Company and Duke Energy. Okay. Southern Company and Duke Energy. So both of them one needs a 4.5% move on the stock to double, and one needs a 5.5% move on the stock to double. Let's see what they've done. All right. Okay. There was a sell, which means there was a buy back here somewhere we don't see. Here's a buy at 48.5 and a sell at, looks like 49.5. Here's a buy at 48 and a rebuy down here at 44. Now, there's been a lot of stocks that have actually gotten clobbered and have not been participating in that big move up that's been going on with the markets. I don't like to chase these. I look at this chart and I just say, let's let that go. And we do this every week. We do this, guys, with our live traders. Duke Energy, let's take a look at it. All right, kind of same situation. Is there anything else I can look at? How about my penny and weekly list that we were talking to you about last week? All right, let's see if there's anything in there that created Darknet trades. IYR and Hershey Company. So IYR we'll take a look at one more time. And you can see here, IYR, even though it did drop to new lows, is giving us a buy situation. Is Hershey any better? And I have not looked at this. Now, this one I like. You know why I like this? Higher lows and higher highs. This thing actually had an uptrend. It broke out of 111, got up to around 116, and pulled back. There's a buy signal that came in at 112. But now there's a rebuy that's down here around the 108, 109 area. And plus, we've seen a couple of days of rebounds too. All right, R could stand for rebound. But we noticed that the last couple signals have been profitable. So let's take this one step farther. So Hershey, all right, if we want to take this one step farther, it's a matter of going in and looking at risk graphs, all right, or going in and looking at the chart itself. HSY, we've already looked at the chart. Let's go look at the options. So these are, by the way, Darknet's trades are typically 30 calendar days. So I want to be looking at February 16th for HSY. Let's type in HSY for Hershey. And I'll have to change that February 16th once again. And there we go. All right, so February 16th is down here at the bottom. Oh, is that only 5? That's 10%. I don't need 10%. I think I only need, let's look and see. How far do we need that to move? We only need Hershey to go up 4.5%. All right. So let's go take a look again. Get rid of these. Let's go to Hershey. So Hershey's I got 115, I got 105, 110, and 115 opportunities. So we could look at I don't like the out of the money, only because even though it says right here, stock percent to double is 4.33. If the stock doubled in value, we're talking about maybe adding on is it 4 points? All right. If you buy an option for 183, oh yeah, if you buy the option for $1.83, that 110, if we go up 4 points, that puts us at 113. That's not the best particular move. I actually think the quality option is the 105s. So the 105s for February are trading for really less than $5, around $5, $4.93 or $493. And again, all we need is a little bit of a move up, and moving up into the blue area, all right, which is our standard deviation. That could take this trade up to about $250. All right, $250 profit on, let's call it $500. That's a 50% return right there. We get up into the red line, which puts us closer to where we were just a month ago. We could get back there. It took a month to go down. It could go back up in a month. This is chocolate. What could chocolate give us? A double. All right, so that's the Hershey 105 call for February. And that's Darknet. And we can, and what we did is we took 37 stocks and we whittled them down to really the one that looked the best, and it had the least amount of slippage and a decent percent to double. Okay. Now, Darknet, again, we've picked a group of stocks that we put into our Darknet stocks that we found back tested out well, have a good slippage factor. The other thing we can look at is we can look at implied volatility, because implied volatility will have a lot to do with whether we do a call or spread, right? So in this case, if we look at Hershey once again, right, you see the Hershey stock. What you don't see is you got to actually go in and look at the actual trade. And this is interesting because the Darknet trade that came up was a little different than the one I picked. Is it's actually looking at a trade that involves the 103 call. I'm sorry, the 106 call. And that's for February 9th. So with a little less time to expiration, and actually $392. All right. But I want you to look down here. Look at the implied volatility. It's not high, but it's not low. It's kind of right in the middle, which is fine. Okay. But let's go back to Darknet again, and let's look at the IYR options, because I believe their implied volatility might be a little bit higher. So here's IYR. Here's the stock. Here's the buy. Look at the IV up on the high range. If you're looking at the low range, which is down here at 8, and high range is just above 14, and we're sitting on 13 right now, we're in the high end of the range. So potentially, we would either look at a deeper in the money option, or we would look at a spread, right? Maybe a deeper in the money option would make sense here. All right, so that's Darknet. And Jay, before I move into Money Calendar, real quickly, I want to let you guys know that we have a lot of material on Darknet on our site. If you go to the help file, go into tomsoptiontools.com, go to help file. We got some free videos out here, and you can do a search on these videos, and it can take you into the Darknet strategy. All right, we have help data on Darknet as well, along with a glossary on the details of how this trading system is built. In fact, it was actually Darknet was was on a recent copy of Stocks and Commodities magazine as one of one of the option trading systems that they looked at and really liked. They loved it, so they actually did an article. They highlighted Darknet as a strategy for option traders on the bullish side. Jay, questions?
Real quick, would you address if a straddle is a viable opportunity around a darknet signal? My answer was this is a predominantly bullish
Yeah,
pattern that we're looking for.
I'm gonna go with that too. A straddle is not.
Yeah,
But what we
agree.
will be doing is I will be doing a bonus class or a bonus session with all of you. It'll be a little bit later into the first quarter. We're going to do a session on straddles. All right. So to the person that asked that question, anybody else in the room, we'll be sending you invitations for straddles. And and by the way, straddles and earnings do have something that go together. So that we're going to be able to talk about earnings and talk about straddles in the same breath. So I will be sharing that information with you later toward the end of the first quarter. We'll be doing a special webinar on that.
And then lastly, a lot of people are talking about the different earnings on these things that you're talking about. So if you want to reiterate your position on what to do when the earnings are ahead of you.
Yeah, on a straight trade, on a particular straight trade, if I'm, I look at earnings patterns, and for me to look at earnings patterns, it would be, I go into, we actually have a little area in here where we go into our stocks, and we can actually go into analysis. And one of our analysis are what's called the earnings effect analysis, and we can look at things like, let's look at PCLN since that's one that we were just talking about. We can look at the best price change before the earnings. All right. So what's the price done before the earnings? And we can see that it's been a toss up, but it's been around 2% move the week before earnings. What's happened to it over the last four earnings after the earnings report comes out? We can look at that and we can say, wow, that's a 7.81% move after earnings. And by the way, 3 of those 4 moves were down. Another reason why I don't like going through earnings for a lot of stocks, because it's that buy the rumor, sell the news piece. But we can also look at implied volatilities of options before and after earnings. We know the implied volatility on Priceline going into earnings, it gets higher by an average of nearly 30%. Your options go up 30% in value, right? What do they do after earnings? I think all of us know the answer to that one. They drop an average of 53% in value. So again, if I didn't say it enough, I don't like holding on to long option trades into earnings. And that's why it has nothing to do with opinion. It has to do with mathematical fact on a stock by stock basis. So you can go in here, those of you guys that are tool members, you should be going in here. If you're that concerned about earnings, go in, punch in your symbol, and look and see what happens to IV before and after the last 4 earnings effects. So we're not done yet, Jay. I want to show everyone the biggest reason that I like Priceline.com and the biggest reason I liked it at the beginning of the year. And it wasn't just Darknet, but we had a kind of I call it a 1-inch putt in the area of trading. And that's something that we call the money calendar. And the money calendar is a way we spot opportunity by looking at price and time. So the money calendar is really the only forward-thinking trading strategy that we have for both price and time that we have that I'm aware of. It hunts down short-term patterns. We can look at these each and every day, not every week, every day. And therefore, we can go through and then start cherry-picking trades that have really nice high reward to risk ratios. Like I said before, this is a application that we're in the process of getting a utility patent for. And so it's very, very valuable to me. So I look at finding stocks with price moves that happen in at least 90% of the last 10 years. So it had to happen. It had to go the same way 90% of the time using a minimum of 10 years data. That was number one. Number two, we narrow those stocks down to the ones with the highest profit opportunities. All right. And then finally, we select the stocks that have the strongest price movements. So from there, I'm looking at option trades that can, I'm trying to double my money in that 30-day or less time frame. That's always my goal when it comes to money calendar. So if I'm looking at a money calendar, I first, money calendar looks like a calendar. It has a monthly view. This is actually this month. And as you can see here, we're into January 17th, and it looks to me like going forward, we got a lot of stocks that go forward into the next 30 days or so that are more bullish than bearish. Each of these colors represent, like tomorrow, 54% of the signals that I have are bullish and 46% are bearish. But take a look what happens after that. The 19th, 91% are bullish. Next week, 90%, 96, 91, 81, 84, and it just keeps going. Great stuff. Now, these are potential trades that we look for. And this was the money calendar, and you're looking at 2017. Last year, Priceline.com came up as a 30-day trade. So beginning of January to mid-February. So from there, what I'll do is I'll click on the Priceline.com piece. You're seeing this right out. I just took these pictures from the software, but we'll actually go and look at it for real in just a moment. But from here, I can look at PCLN, and I can see the trade length, how long it lasts. I can see how bullish it was. This was 100% accurate, guys. This was 100% accurate, 10 for 10, going into last year and going into February, into January 2017. And by the way, it worked again. We looked at the 1590s last year and the 1600s. And that was a trade that was being done for about 320, but market was around 400. So there, you're talking about a trade that more than double in value, actually could triple in value over the course of that time frame. By the way, Priceline.com ended up increasing over 5% during this period, and the option trade did double and did triple in value during that time. So let's go look at money calendar, and I want to show you what it looks like today. So here's what we got going on in money calendar. I'll show you a couple of cool things. I see some of our tool users in the room. I want to show you guys that don't know this yet, something brand new. This is money calendar right now. We're looking at the actual chart. Here's the 17th. Okay, I could back up and I could show you Priceline, but if we actually looked at, let's call it, let's look at the 17th. And you can see all the different stocks that are coming up that are bullish. Look at Priceline.com right up here in number 3. All right. The reason we like this so much is look at the pattern. The patterns have been great every year. And I can go in and I can do some analysis, because the computer has so much stuff that we've plugged into it. We know the buy date. We know the sell date. All right. We know how much it's done during that time frame. It netted over 1,000 points in the last 10 years. All right. We know that on average it did over 100 points during the time frame. But we also know that look at the last 4 years, over 150 points. 2015 went up 240 points. All right. We can click on any of these bars and we can get the data for the chart from the beginning of the pattern to the end of the pattern. 2016, 2015, 2014, 2013, 12, etc. So you can see there, we can actually get really into the minutia of the actual trade. This is why I went from, this is why I looked at Priceline.com, that the 1900, 2000 call spread with you earlier tonight, because of the money calendar. Because the ability, I can go in and I can click on month, and I can look and see, all right, what's going on Friday? It starts getting bullish on Friday. What do we got happening? Well, Netflix, LNG, that's liquefied natural gas, or Chesapeake Energy. Let me see that one. That looks good, because you know what's happening? The trend is coming in. Looks like the last couple of years, 468, 852, 357. So roughly when you look at that, I see about a 5-point move here in the last few years. So then what I do is I take a look at Chesapeake and I get an idea where it is. So I'll go to a stock chart, stocks, charts, stock charts, and I'll type in LNG. And let's take a look at that. Cheniere, not Chesapeake. Cheniere Energy. Wow, you know what? Talk about buying on a high. This is great. And, natural gas has actually come back and has actually been doing quite well along with the rest of the energy markets. So the trend actually looks good, and we're going into a bullish time frame. And so now it's just a matter of, I look at the chart, I get an idea. I got an idea where I like it to go. It's trading right now around 55.73, so maybe it's 60 as my price target over that next 30-day time frame. So what do we do next? We spotted the opportunity. Let's create the low-risk trade. So go to option chains, and I'll go out here to February 16th, which is my 30-day option. I'm going to go ahead and update that. I'm going to look out here. I'm going to say to myself, all right, I'm looking for a 5-point move. So if I have a 55 call, let's just look at what one contract is going to run. A 5-point move on the stock, being that it's close to 56, would put it at 61. All right, a 55 call at 61 is going to be worth 6 points. This thing's trading for $2.21. If it gets to 60, it's going to be more than double in value the options would be. All right, so that's how we do it, folks. We spot the opportunity. In this case, I'm using Money Calendar. We looked at Darknet as well, but in this particular example, I used Money Calendar to spot the opportunity. Create the low-risk trade. You go out there and you punch in and get your risk graph on that trade. And it's just a matter of planning the trade, executing the trade, and then managing the trade. How would you, we not execute the trade, but how would you manage this trade? Well, if it got back down here around, let's call it 53.5, before, if it dropped back down below 53.5, maybe that's a stop. It's time to get out and go home. All right. How do you know what's the worst case scenario on it? Go back and look at Money Calendar, because you know what Money Calendar also tells you? What the worst drawdown was at that time. The worst drawdown, max drawdown, was $5.87. These are beginning to end. They do not include what happened in the middle. But if the max drawdown was 587, look at the max run up, 914. That's good. I like a bigger run up than a drawdown. But 587 tells me that if we go back down to, let's call it 50, then maybe I need to bail out of it. Spot the opportunity. Create the low-risk trade, which we did here. And then just plan, execute, and manage the trade. Let me show you one more. So Money Calendar doesn't do just stocks, but we also look at ETFs. This is the ETFs on Money Calendar. By the way, to get to ETFs, up here where it says Money Calendar, I can toggle that back and forth from the stock market to the ETF market. I'm looking at January 19th. That's this Friday. I've got XRT. I've got XLY, I've got DBC, I've got IYR. You might be going, why is IYR? Are you kidding me? Is IYR both a Money Calendar trade and a Darknet trade? Yep, sure is. But what I really like to look at these at is something called the power meter. And XLY is high on the power meter. IWM is also. Let's take a look at IWM. IWM is the Russell, all right? That's the Russell ETF. Between January 19th and February 26th. Let's cruise on down here. 2009 was not a good year for the Russell. Let me tell you something. If you guys remember 2009 about this time, I know it's hard, but go back. 2008 was the big drop. 2009 was the second drop. All right, that ended in March. But you can see what happened the last 8 years. All right, the last 7 years. The last 3 years, we were on an average of about 5-point move. So, what happened last year? A lot of that. That's what we like to see. A lot of move in the right direction. So, we would go to IWN or M, all right? Go out to your stock and options, or you can do this in any place you look at option strategies, but IWM. And we're going from spotting the opportunity to creating that low-risk trade. Now, back to Money Calendar for a minute while that's cooking, all right? We're looking at an average move of about 5 points. Not much. All right. So when you look at this and you go out to February 16th, which is that 30-day move, actually, you know what? We needed more. We needed more than that. Let's go back again. The ending date was February 26th. See that? So I need an option that expires after February 26th. We got to go to the March 2nd options. Let's update it with the March 2nd options. You know what I smell here? I smell a spread. I smell a spread. 5 points. Where are we at right now? 157.64. So let's call that 158. 59, 60, 61, 62, 63. Is there anything out there at 60? There's not a 63. There's a 62. Sell the 62, please. All right. Let's sell that times 2. And what I want to do is I want to come down 61, 60, maybe 59. Maybe we buy the 59 twice. So that's a 3-point spread. How much is this 3-point spread going to cost me? Well, I'm going to find out right now. So we hit the risk graph and we see, all right, $111 per contract, or if you do 2 contracts, it's $222. Really good tight slippage. That's great too. and a nice fat 170% maximum return on the trade. Oh, and the best part? It only has to go up a couple points to get the max return. This is the March 2nd, 159 calls, selling the March 2nd, 162 calls. All right? This is a case study. Do your own homework. Pick your own trades if you like them. But if you want to do what we do, you don't just go out and approach a trade because you hope it's going higher or you think it's going higher. You do it because you have a set of rules. And in thick and thin, rules will always work versus no rules. Okay? So whether you like it or not, and I'm going to move this into a completely different area just for a moment, governments are set up for rules. And, most of us don't like the rules. I mean, I could definitely do without the tax implication of the rules. But imagine if there were no government. There'd be total chaos, and the world may not be such a great place to live in, right? But because there are rules that most of us abide by, rule-abiding citizens seem to have a better life than non-rule-abiding citizens. I want you thinking about it as a trader, too. If you're a rule-abiding trader, you're going to have a better life as a trader than if you are a non-rule-abiding trader, okay? I've shown you a couple different ways that we can look at rules, and that was through the Darknet strategy and the money counter strategy. We talked about low-risk trades. We talked about spreads as an alternative to trading call options on their own or even put options on their own if you're bearish in the market. So last thing I want to show you is homework, a little homework assignment I have for you. And so I'd like you to follow the case studies that we have discussed tonight, all right, especially Priceline.com, all right. And then if you go back and take a look here, we talked about Priceline, we talked about IWM, we talked about Hershey, all right. We talked about liquefied natural gas or Cheniere. So those are the big ones I want you to concentrate on. And for those of you that want some more information on Darknet and Money Counter, you can watch the Darknet and Money Counter links. You can go to our YouTube site. That's www.youtube.com/Tom's Trading Room. All right. As a subscriber, you can look at all of them, but then you'll get notifications when we post new ones, which go up on average once a week. We're putting new videos up. All right. Also, for new subscribers, you can get a free full trial to everything, including Money Counter and Darknet that I just talked about, by logging on to tomsoptiontools.com. You click into tomsoptiontools.com, you'll come here. If you don't have a username and password, you're a new user. Come up here and click on this little button to the right, 7-day trial. It'll take you to all the different trials we have. We do not have a trial on our professional trader member. All right, we don't even have that membership. We have membership full right now. But if you're interested in that professional level, all right, you like our tools, and you want to go up to pro, my suggestion is do this if you're new to us. Try these, all right? The level 3 is going to give you the best looking, the best look at what we have, because you're going to get level 1, level 2, and you're going to get Money Calendar, all right? Also comes with full support, Skype, email, etc. And you'll see by clicking on what you get, it shows you what you get through level 3. That's a full trial for 1 week. And then after that, you can, we've got, we're discounting these 50% off our regular published price. So you'll get the discount. Well, also, if you get the complete trader, you're going to get the either complete or contrarian. You'll get my weekly market alert publication, which, by the way, goes out midweek. The new one just went up tonight for those of you that are Tools members. And if you tried this, or if you currently have this, and you want to bump yourself up to professional level, get a hold of Jay. We have a few spots. All right, first come, first serve, and he can get you the details on professional level, but we'll give you a healthy discount off of that regular price as well. All right, guys. Thank you very much. Next week, we'll be doing a review of tonight. We'll also be going over the homework that we talked about tonight. We'll continue our case studies with Darknet and Money Counter if there happen to be any good ones. And my guest next week will be Devin Pearsall, who will be talking about credit spreads and how to layer credit spreads. All right. Jay, any final thoughts before we finish up tonight?
Nope, you covered it. You told them how to get a hold of me for these pricing questions and the annual special there. So I look forward to taking care of people starting tomorrow.
Yeah, and just lastly, I'm going to put it in here for you guys. in the chat box, www.tomgentile.com/trading tools. That's another way you can get to that special offer for that 1 week free trial. All right. And also gives you those great prices that we have for our Optionetics students. All right. Thank you, everybody. Have a great night. I'll have a recording to you later on this evening, and we look forward to seeing you next week. Oh, by the way, before you go, don't hit that exit button too quick. We're going to have a time change next week. Jay, and I need to let you know that too. Next week we will not be on at 8 o'clock. We're actually going to be on at noon. All right, because I want this guy Devin in here so bad that I had to make a time change for him. So we will make sure that you get that change. I'm going to make that change tonight as well. You'll see that. I'll make sure you know that in your mail. And we hope to see you next Wednesday at noon. Of course, the session will be recorded in case you can't make it. But till then, guys, have a great evening, and we'll see you soon. Bye now.